how do we conduct an income statement review, and what is the P&L really telling you? Um, so if we want to flip to the next, um, so here are some of the components of financial diligence, and you'll see one of them is that financial statement analysis. Um, so this is one of the five big buckets of conducting due diligence on your acquisition or proposed acquisition. So for those actively searching, you'll likely receive P&Ls or other materials from the company. And this is a component. So let's unpack, what are some of these things to look out for. So what the P&L is really telling you is, some of the risks and ways to mitigate it, uncovering some hidden issues, and really you want to set the foundation for a successful acquisition. So when I think about um, the profit and loss analysis, this is a quick timeline for those of you under LOI. If you want to take a screenshot of this, this gives you your 90-day roadmap on how to uh, close a business in 90 days. You'll see typically you kick off with financial due diligence, and that profit and loss analysis is a key component. If you have any questions during the webinar, feel free to write them in the chat, and I'll try to get to them near the end of the webinar. So let's do the deep dive. So think back. This is what is the P&L really telling you? And it starts at the income statement level. So the income statement deep dive is going to look at things such as the net profit margin, which is the overall profitability um, of the business you're looking at. Um, you're going to look at things like the EBITDA margin. EBITDA is to show the operational performance of the small business. And then the gross profit margin is the efficiency in the gross profit, the revenues less the direct costs of the business. So when we think about the income statement and the profit and loss statement, what we're looking at is the margin level. So whenever I look at a P&L, I will immediately go to the margins and start to calculate margins on a monthly basis or an annual basis to see if they're consistent with the historical period. So if the company is showing margins of 20% in the first year, 25% in the second year, and 50% in the third year, something has changed with the company. So the company is either producing more revenues or they're having more cost efficiencies in order to increase those revenue, increase those margins. So looking at the margin level is a technique that I will use to quickly assess the health of the business and the sustainability. If we want to keep it moving, so how should you conduct this income statement review? So I want you to picture this. For those of you actively searching, you reach out to the seller representatives and you ask for a annual P&L for a few years. So you'll see here, this is showing an income statement uh, on a monthly basis rolled up into totals for 2021, 2022, and 2023. And then the January period through November of 24. So if we zoom in, you'll see the company had incomes of about 1.1 million. And then in 23 and 24, it increased to 1.6. You'll see the company had operating expenses of about $1 million in 23 and 24. What I just mentioned is I would likely start calculating the margins. So you'll see there's a gross margin, there's a net ordinary income margin, and then there's an EBITDA margin. So there's a couple takeaways I would assess immediately from the company. So you'll see, let's start with the latest period. So the November 18, 2024 period. The company is producing about 30% margins, which are very healthy for a small business in this industry. It's no coincidence that the company is going to market or trying to be sold in the period of the best performance over the last couple of years. You'll see in 23, the margins of the same business with similar revenues. So they, in 2023, had 1.6 million of revenues, but the margins were about 14% if we look at the last row of EBITDA margin. And then in the prior period, 9%. And then in the first period showing here in 2021, it had 27% margins. So once you set up a table that looks like this, I would begin asking management or the sellers questions about what changed with the business. So I'd love to hear from you. What are some of the questions you would ask about this P&L looking at it? If you want to put them in the chat, I'm happy to answer and chime in as well. But when you look at something like this, what are some of the questions you would want to ask about the business? As you're throwing in some of those ideas, I'll give you some of my takeaways. So I would ask, focus solely on 2023 and 2024 and double click on the change in the margins. So when I see a company with similar revenues, 1.6 million, but all of a sudden the margin profile increases, so it goes from 14% to 30%, I would want to know what changed from a expense standpoint. And Mike, I agree what you're saying. Why have the cost of goods sold decreased from 23 to 24? But the profitability is going up. Also, if you look at the operating expenses are showing 1.1 million and then 1 million for 11 months. So there's something with the costs that are changing over the period. The cost profile, you want to unpack what happened with the cost of goods sold. I would also probably want to unpack the operating expenses and see some of those components. You'll see that operating expenses are about $1 million through 10 and a half months of the period. So they're on track to do a little bit less. I believe my math is correct. Yeah, so the company is on track to do about 1.14 million of operating expenses over the 12-month period in 24. So again, they've cut a few costs, it looks like, or they're using less cost of goods sold and operating expenses to produce similar or higher levels of income. So that's what I would want to learn more about. You could unpack the composition of the incomes, understand what are some of the drivers of the income. Is it sustainable, et cetera. So just to recap, when I'm looking at a P&L, I want to first line up the statements and then go to the margins and start calculating the gross margin, the net income margin, and the EBITDA margin. Those margins paint a clearer picture in my mind about how the company is performing. So while a lot of folks will focus on top line income changes, I go to the margin level because there's things such as the change in costs that could be due to the operational efficiencies, or more importantly, it could be due to an accounting reclassification or ways that they're accounting for cost of goods sold, depending on the type of business, that you need to understand, is this truly an operating efficiency that they're taking advantage of, or are they doing clever accounting to show more profitability for a similar business? So just be careful when you're looking at things like this, because it can get a lot of people can get caught with this. We want to flip to the next slide. So let's do another example. So here's another example. So picture this, different company. You'll see that incomes of 21, 22, and 23 are about $4 million. Um, what also I like to do is I will add historical column changes. So you'll see it says historical analysis, year-on-year changes. And it's a quick, visual to look at percentages increased or decreased over, year over year. So if we look at this and we look at column BC and BB, you'll see that the company had incomes increases from 22 to 23 of about 5%. Additionally, the gross profit or the profitability increased 9%. So while income revenues only increased 4%, they actually doubled profitability. And you'll see that the gross margins went from 67 to 71%, which, so a couple takeaways from this. When I look at a company like this, gross margins of 70%, very likely there are items but below the line in the total expenses of operating that relate to the direct cost of the business. So there may be some classification issues. Typically, most businesses aren't operating on a gross margin basis of 70%. So I would want to unpack this total expense line item to make sure there aren't direct costs or direct labor costs that are being pushed below the line. If we look at if we scroll all the way down to a net basis, while the company is showing increases in income or top line revenue, it's actually performing worse on a net basis. You'll see that net incomes declined 3%. So this is an example I like to walk through because a lot of times when folks looking to buy businesses, they're only focused on the top line metrics, but you want to scroll down and see how is the profitability profile look of the company. While the company increased top line by 4% from 22 to 23, it actually lost money. So were those increases in revenue due to, vanity metrics, increased in marketing initiatives to drive those dollars? But in reality, it might not have made sense from a profitability standpoint. Occasionally, when companies are going to market, they will do whatever it takes to increase top line revenue, but it actually may hurt the overall profitability of the company. The reason why it's important for you as a buyer to understand this is most, if not all of you, will be using some sort of a debt in order to purchase this business. And the debt payments will be used from this net income, this cash flow of the business. If the cash flow of the business is not what you expect, you're going to have significant challenges paying the debt payments. So focusing on the profitability year over year and understanding what does the normal net incomes look like of a company like this. Um, you'll see in a couple other takeaways in 2021, the company had net incomes of 2.1 million on 4.4 million of income, which is very strong. It's nearly 50% net margins, which is, it's tremendous. Um, Looking at this business, it seems like they were operating most efficiently, in my opinion, at in 2021. And then in 22 and 23, there's been changes to the company, and it's just not as profitable or operationally sound as before. So when you look at something like this, what are some of the questions you would want to ask management about this? Some of the questions I would ask is, have there been any changes in the personnel of the company? Who runs the day-to-day operations? Um, why did sales decline from 21 to 22 and then go back up in 23? I would also ask questions about walking me through how the company records costs of goods sold. What are some of the direct costs of the business? And then I would walk through what does the rest of 2024 look like? So you'll see in column AW, January through May, is just a year-to-date picture. I would want to see, if we assumed this was June or July of 24, I would want to know what the rest of the year looks like for this business. Um, if you have any more thoughts about this, I'd love to hear, some comments feel free to throw them in the chat. Let's see. Want to go to the next slide. So if you want to get the checklist we use for a lot of our deals, feel free to scan this QR code. It includes things like the Business Buyer's Toolkit, which is a 92-page guide I put together. You'll find this as well as my ebook on how to find and do better deals by scanning that QR code. If you want to scan this as well, this is the due diligence checklist. So for those of you under LOI, I use a checklist, which is a data checklist of some of the key things you're going to need from the company, things like tax returns, bank statements, etc., in a uh, in a clean Excel document. If you want to scan that QR code, you can receive your copy today. It's very helpful and it's something I use on all my deals. Next week, as part of the 2026 webinar series, I'm going to be walking through the balance sheet, how I do reviews of a balance sheet as it pertains to these small business acquisitions, things to look out for. We're going to walk through a couple examples. If you want to scan the QR code or register on my LinkedIn page, you'll get a notification of when the webinar starts. Also, if you head over to my YouTube channel, you'll get an alert when we do go live for this. So feel free to use both of those outlets to make sure you don't miss the next one. All of these webinars and more can be found on my YouTube channel. You can just search at Patrick O'Connell. This content is something I put together over the last year and a half, and it's really aimed at educational purposes to do better deals as an entrepreneur. And I've started and purchased, multiple companies, and the tools I share, I hope you can do better deals with. For those of you who are self-funded searchers in the ETA community, I've been in the small business world for over a decade. So hopefully some of the content I share you can use for your deals ongoing. If you have any more questions, feel free to put them in the chat and Q&A. I left ourselves, several minutes to talk specifics. So I'd love to hear from you. If you have any other questions you forgot to ask, my line's always open. Feel free to send me a message on LinkedIn if you have questions about your deal, how we could work together, or things you're seeing in the market. I love hearing from the SMB community. So feel free to give me a shout. I'd love to hear from you. So while we wait, I had a few questions that came in. The first one was, is there a margin minimum you adhere to? So that's a good question. And Amanda, thank you so much for uh, posting a question. So when I think about margins, here's my advice. Based on the type of industry, I would use industry resources to understand what are typical margins for a business in this space. So if you're looking at a roofing company that does commercial work, there's several resources you can use online to understand what are typical margins. So what are normal margins of a business in this industry? You might be able to figure out, are there certain industries and regions that are more or less profitable? And then based on that understanding from the market landscape, understand now what is this particular business? Does this jive with what is industry norm? Here's what I say. If you see things that are outside of the norm, so if they're too high, if the margins are significantly higher than the averages, I would ask questions about that. If they're significantly lower, I would ask questions about that. You can ask the brokers or the seller representatives around, about those margin questions. You can keep it as broad as, typical margins in the industry, I think are, let's say 20%. Can you walk me through why those are, 40%? Like, what is the company doing well to produce those? That's typically how I think about the margin profile. Again, using online resources that are most often free is your best bet to understand, is the business you're looking at and excited about in line with, typical margins for that industry? Let's see. Another question. Uh, how do I go about asking for some of the data if I'm in the pre-LOI stage? So that's a good question. For those, and this applies to those actively searching. So before you have a letter of intent, you likely won't have access to all the information for the company. So they may give you annual financial statements, or a couple periods, and the data might be limited. I will say once you do go under LOI, you should have access to monthly statements, a general ledger, and all the details you need to articulate and understand what are the components of revenues, what are the components of expenses. But when you're in the pre-LOI phase, you're at a disadvantage to the data you can use. So good news, you can perform a lot of these analysis, like looking at margins year over year, with limited information. It might take a little bit of rolling up your sleeves to put this together in an Excel document. They might give you PDFs, etc. But a lot of the calculations we walked through looking at the margins year over year can be pretty easily formatted into an Excel document, which you can type up questions on. That's what I do as the financial due diligence provider. Once we line up the monthly P&Ls, we will write alongside it in Excel questions for management. And then we're going to have a meaningful conversation about what those changes look like. And this can be done at a high level even before you go under contract. They may push back and not give you all the information, but you can still get a flavor for, hey, how is this business performing? Do I understand at a high level, is the business trending upward? Is it trending downward? Before you do have serious conversations and submit that bid. Mike, thank you for the question. So Mike asked, how should we evaluate at the COVID years for future performance? Taking into account some of those years may be anomalies, both high and low. So it's a great question. So during the COVID period, you want to understand what type of business it's for. If it had significant impacts for COVID, that impacts your valuations. If it was directly COVID related, if it was part of a trend during COVID, it's very likely that the business has began to decline as we sit in 2026. A lot of the COVID periods were in 21 and 22. Certainly, there's overlay. Some businesses did very well in 2020. Others, their best year was in 21. So taking into account the normalized level is really the question you're looking for. What are the normalized levels of revenues and what are the normalized net income levels of the business you're looking to purchase? How you can get around that is by stretching your period. I would look at maybe a 5-year horizon if there is significant COVID financial assessment that's impacting. In large part, as we get further away from the COVID years, in my opinion, it's less impactful to your analysis, but it depends on the type of business you're looking for. Let's see. Don't have any more questions come in. So with that, I'm going to pause today's webinar. Thank you so much for joining. If you have any questions additionally about your deal, feel free to reach out to me on LinkedIn or send me an email at patrick@o'connelladvisorgroup.com. With that, I'll go ahead and conclude today's webinar. Thank you so much for attending. I hope to see you next week and the weeks prior as we kick off the 2026 webinar series. Thank you all. Have a great day.